morning, everyone. Thanks for coming. I'm Bruce Allen. I'm with Mid-Atlantic Federal Credit Union. We're based in Germantown, although we have 3 branches. They keep me in Germantown. I'm a loan officer with Mid-Atlantic. I've been in the mortgage business for 23 years in various roles and have seen a lot of changes in the industry and in our market during that time. But things have really settled into what I think is a nice stable process and environment to buy a home, to get a loan, and so we're going to talk about that this morning. A couple questions for you guys right off. Has anyone purchased a home before, or do you currently own a home? Okay, next question, anyone here a veteran? Okay, so that kind of tells me which material I need to focus more on. So becoming a homeowner is what we're discussing this morning. So Mid-Atlantic started out as IBM Federal Credit Union in 1968 down in Bethesda, and it expanded, and we've really expanded into a Montgomery County-centric credit union. It's pretty easy to join. You have to have some connection to Montgomery County. Either live in the county, work in the county, go to school in the county, volunteer, or if you're purchasing in Montgomery County and you need $5 for your savings account, you're a member. It's just that easy. Most credit, as far as I know, all credit unions are not-for-profit entities, and we're going to talk a little bit more about that later. Mid-Atlantic is a not-for-profit member-owned credit union. And being member-owned means there's a lot of differences in the culture and how we do things, our philosophy in terms of customer service or member service, among other things. As I mentioned, we have 3 branches. There's one in Silver Spring on New Hampshire Avenue. There's one in Gaithersburg, and I work at the headquarters in Germantown on Wisteria Drive. And we lend in all 50 states. So if you guys are ready to buy that house in Maui, we're right there with you. I may even have to go with you to, make sure everything's good. Why use Mid-Atlantic Federal Credit Union? Why not use a bank, a broker, or an online lender? Well, I'm going to start with the broker thing first. A broker is not a lender. They will broker your loan to a lender like us, hence the name broker. Those guys need to eat too. So you're adding another layer of process, you're adding another layer of fees if you go with a broker. A bank is a lender, just like we are a lender at the credit union, but banks are in love with fees, as we all know. They will dream up fees for all sorts of things. We don't do that at the credit union. We just we do have fees associated with the loan. They're about a half to a third of what most banks charge, and we don't ding you for every little thing. And online lenders, you want to be very careful. That is certainly a source of a loan, but if you're purchasing a home, you want to use a local lender, a local presence. Most realtors you'll talk to will beg you to use a local lender and not someone, because most of these online lenders will outsource at least part of the loan process, usually to India. So after they take your application, it goes over to India to be processed. The person that took your application, never going to see it again. So if you have a question or you have a problem that needs to be resolved, they're really ill-equipped to help you. They're probably not even going to know where your loan is. Our rates are very competitive, particularly 30-year fixed rate. We also offer FHA, VA loans, which I'll get to more in a minute, but the rates are all very competitive. Fees I just spoke about were roughly a third to a half of what most lenders charge. Everything is done in Germantown. So I spoke a minute ago about the outsourcing that the big banks and the online lenders do. We don't do that. My processor, my underwriter, my loan closer sit about 40 feet away from me in the same building on the 2nd floor up here in Germantown. So unlike an online lender who, takes your application and never sees it again, I have my hands on it from beginning to end, as does everyone on our team, and it's local. So you could actually come see us if you needed to. Experience in lending, I touched upon my experience a little bit, but there are other people there, even my boss is a mortgage banking guy. It's one of the reasons I went to Mid-Atlantic over 3 years ago, because most banks and credit unions, believe it or not, don't have mortgage experienced management. They offer mortgage loans because they have to offer mortgage loans to their customers. It's required by law. That doesn't mean they're good at it. And as I said a moment ago, lending in all 50 states. And perhaps the very best thing about being here, and when the time comes, down here, highlighted in yellow, is we're going to provide you with $1,000 in lender credit toward your closing costs. So that reduces the cash you'll need at closing by $1,000. That doesn't mean you're limited to that. We may be able to offer additional lender credit when the time comes. We won't really know that till you have a contract to buy a house and we're locking in your rate. Example, I got one yesterday, and we offered the lender credit. We knew she was going to get that much, but she ended up getting another $1,500 on top of that. So we're providing $2,500 toward her closing costs. She was pretty happy. What type of mortgages do we provide? Well, we have conventional loans, FHA, VA. I'm not going to spend any time talking about VA since there are no veterans in here today. Conventional, you all heard of Fannie Mae. Fannie Mae lending guidelines are the industry standard. Every lender is playing by the same rules. Whether you use us or some other kind of lender, we're all lending based off Fannie Mae guides. FHA guides, FHA stands for Federal Housing Authority. It's a government-insured lending program. It is very accommodating. It has been around since the end of the Second World War, and it really hasn't changed that much. It was designed to enable and provide GIs returning from war with a way to buy a house, get a low fixed rate with very little money down. FHA only requires a 3.5% down payment. Portfolio ARMs. Everyone know what an ARM is? It's an acronym for adjustable rate mortgage. So it's not a fixed rate, it's an adjustable rate mortgage. It's not as scary as it sounds. The rate will be fixed for a period of time before it adjusts, either 5 years, 7 years, or 10 years. Portfolio means it's in-house. It's our own loan program. It's based off Fannie Mae guidelines, but we keep those loans and service them ourselves. We don't sell them off in the secondary market like we do with fixed-rate loans. And does everyone know what a HELOC is? We love our acronyms in this business. HELOC is Home Equity Line of Credit. It's a second mortgage. And we'll talk a little bit more about why that would matter to you. It might not. Why select an ARM, or adjustable rate mortgage, instead of a fixed rate mortgage, and what are the risks? Well, the biggest reason right there. ARMs will provide you with a lower rate for the period of time that the rate is fixed, and perhaps even for the whole life of the loan. But the risk is after a certain period of time, either after 5 years, 7 years, or 10 years, the rate will no longer be fixed. So it could go up, or it could go down, or it could stay the same. No one knows. People that do ARM loans are doing that with maybe one of two reasons. One is they want the lower rate for the time they'll have that loan, but there's nothing that says you have to keep that loan for any minimum period of time. So you can refinance in a year into a fixed rate loan, or in 6 months into a fixed rate loan if it makes sense for you to do so at that time. No prepayment penalties on any of our loans. You don't have to keep any of them for any minimum period of time. So, I put this bullet point in. So if you know you're going to sell the property, say within 5 to 7 years, do a 7-1 ARM. That rate's going to be about 0.5% lower than a 30-year fixed, maybe even more. And that's big. That makes a big difference in your monthly payment. And if you're selling the property before the rate or the loan program turns into an adjustable rate mortgage, it's as good as a fixed rate to you. Rate caps. When they do become ARMs, if you still have it once it's adjusting, those rates are capped. They can only go up by a certain amount, so it provides you with some protection there. And they vary from one program to the next. So if you're looking at an ARM, we'll talk more about that at that time.
Can you break down that section? I assume it's 10 years for 1%, or can you break down what those numbers mean?
These here? Sure. 10-1 means the rate is fixed for 10 years before it becomes an adjustable rate mortgage. After 10 years, it can adjust every month, up or down, depending upon the market. 7-1 is fixed for 7 years. 5-1 is fixed for 5 years. The 5-5 is a little bit different. That one's fixed for 5 years. It will adjust once, and then it's fixed for another 5 years. So it's a lot like a 10-year ARM. The effective rate over 10 years on that thing is low. So it's a good program. Most people prefer fixed rate. And quite honestly, the fixed rates are still pretty low. But I do have people that do the ARMs too. I locked one person in earlier this week, and it was a 0.5% difference from the 30-year fixed to the ARM. That's a lot. It's a big difference in payment. And prepayment penalties, as I mentioned, there are none. So there's, again, nothing that says you have to keep it. Credit scores. What does your minimum score need to be? This is always a popular topic. I could spend 2 hours just talking about credit. It's different for the programs. FHA guidelines require a middle score of 580, conventional, or VA 620. We use the middle of 3 scores, and if the application has a borrower and a co-borrower, we use the middle score in the lower set of 3. We don't average the scores. Once upon a time, years ago, that was done, but not for a long time. And that's industry-wide, by the way. That's the same anywhere. There are 3 credit repositories. I'm sure you all have heard of Experian, Equifax, TransUnion. And they all have a different scoring model. After 23 years, I still don't know why. Don't ask me why. I don't know why, but that's why we have 3 different scores, because each of these repositories has a different scoring model, a different way of arriving at credit scores. If you've had a bankruptcy, you need at least 2 years from the bankruptcy discharge for an FHA loan, 3 years to do a conventional loan. If you've had a foreclosure, which no one in here, because no one said they've owned a home, but it's add a year to those. So 3 years for FHA, then 4 years for conventional. Date of sale of the mortgage, including bankruptcy. I'll talk to you more about that offline if it applies to you. How much do you need for down payment and closing costs? Well, we have programs that require 0% down. One of those is VA. The other is what we call a combo loan, a first mortgage and a second mortgage. And that's where we get back to the HELOC, the home equity and line of credit. So the first mortgage would be one of our ARM products, 5-year, 7-year, 10-year. And then there's a second mortgage that we do simultaneously. So it's also sometimes called an 80-20 loan. So the first mortgage provides you with 80% of the purchase price, and then the second mortgage the last 20%, so 0% down. A common question, a common misconception that I get is, well, if I can do a 100% loan, I don't need any money to buy a house. You still need some. You'll have closing costs, and those are typically 2.5% to 3% of the purchase price. So if you're buying a $350,000 house, which is a pretty typical purchase price in our area, you're going to need upwards of $10,000, $11,000 just for closing costs. Now, yeah, at the low end is right. I mean, they can be higher. It just depends on where you're buying. A lot of closing costs are transfer taxes to the county, so that varies from one jurisdiction or municipality to another, things like that. If you're choosing to pay points to buy down your rate and get a lower interest rate, those are closing costs, and those can add on to, that's, again, typical but not etched in stone for everybody everywhere. Sometimes a little more, sometimes a little less. What is lender credit? Well, I spoke about that a minute ago. So we're providing you with $1,000. And in the case of my borrower yesterday who I locked in, she selected an interest rate that happened to provide another $1,500 in lender credit to her. So she's getting a total of $2,500. Does that mean we give you $2,500? No, we don't hand you cash for it. We cover that directly it's applied directly toward your closing costs at settlement. But the result is that much less you need to take out of your bank, or you need, to do the transaction. Seller credit, not done much right now, simply because it's a seller's market. The inventories are low. There's more demand right now than there is supply there's houses for sale, but it's low. Inventory is low, and that kind of puts the seller in the driver's seat. Most of them are not providing credit because they don't have to. They're getting multiple offers for their home, usually within days of listing it. Gift funds. If you have a generous, immediate family member who wants to provide you with a gift toward the purchase of the home, totally fine. It's called gift funds. There's a little bit of a process we go through to enable that. It's not difficult, and it's done quite often. Yes?
Does it matter if the home is foreclosed, like any type of condition the home is, there's still to be a loan?
It's a great question. It does matter. The home appraisal has to be as is. It can't be what's known as subject to repairs or a completion of an unfinished property. So if you find a foreclosure property for sale, just, you're going to want to use an agent, and they're going to guide you through that. But, just be careful. If the appraisal came back subject to, then, everything's going to stop right there. You'll want to do a home inspection too, no matter what. Whether it's brand new construction or a 100-year-old house. It's not required by the lender, it's not required by us, but you'll want to do that for your own benefit. It'll cost you between $350 and $500 to pay the inspector, but it can prevent you from making a $300,000 mistake. They'll look for things you won't see. If the foundation is cracked or, the roof's about to cave in. I mean, you or I wouldn't see that looking at a house, but they will, and they're working for you. It's important. Should you use a realtor? Absolutely. My goodness, don't go into this without representation. Who pays the realtor? That's the best, might be the best thing you hear all day today. The seller pays the realtor. The seller pays your agent, and they pay their agent. So a lot of people are apprehensive to sign on or sign a buyer's agreement with a realtor. So they think, I can't afford that. No, you don't pay them. That's not on you. But they represent you and your interests. You need them for help with the contract. And quite honestly, in this seller's market, I don't think sellers would even entertain an offer from somebody who's not represented. Yeah, they can be picky. What happens if you don't sign a buyer's agreement with a realtor? Say you speak with an agent and they show you houses and you don't sign the buyer's agreement, and they're giving you all this advice and expertise and showing you properties. Until you sign that buyer's agreement with a realtor, that realtor is working for the seller. So just be aware of that. And we just talked about that. So I couldn't wait to give you the good news. Seller's market, we just talked about. It's simply supply and demand. But this is what's important about the way we pre-approve you at Mid-Atlantic Federal Credit Union. We verify income, we verify assets. I actually run you through automated underwriting on Fannie Mae's website. And I put all of that in the pre-approval letter. So the seller and their agent, who are looking at maybe 3, 4, 5 offers and 3 or 4 or 5 different pre-approval letters, they're going to toss aside the old pre-qual letter. They don't even want to see that anymore. They want to know that your stuff has been verified. And even though my letter says it, they still call me and kind of interview me. Hey, how'd you pre-approve them? Well, I collected W-2s, I collected pay stubs and bank statements. We ran it through automated underwriting, and they are looking really good. Makes them feel a lot better about entering into a contract with you. They don't want to enter into a contract with someone if it can be avoided, if they're worried about the borrower, the buyer, getting approved in underwriting. It becomes a waste of their time. Okay, no veterans here. So a couple of people came in after we started, and I asked right off, is anyone a veteran? Okay. What are your first steps? How and where do you apply? And how much does it cost to apply for pre-approval? First step, call me or email me. You'll see my card in the folder in front of you, and we can do it over the phone. Most of the applications I take are over the phone. Or you can come see me in Germantown, but we don't require that you come in to apply. It takes about 10 minutes usually to do an app, and it costs nothing. We don't charge for pre-approvals. We don't charge application fees. And applying for a loan with me does not obligate you to use me. So I could pre-approve you, but if you decided you wanted to go elsewhere for the loan, you can do that. You're not signing your life away by, getting pre-approved with me. Obviously, we hope you use us for the loan, but you need to be a member by the time your loan goes into underwriting, and that's pretty easy to sign up to. But you don't even need to be a member to get pre-approved. So don't let that hold you up if you're ready to apply now, or you just want to see where you are in terms of how much will you qualify for. I can help you with that right now. What documentation is needed? Well, I'm not going to go through the whole list. In the folder on the left side and the back is a list of what we typically need from most people. It varies from person to person, so it depends on how you earn your living. If you're an employee, you're salaried, then I'll need W-2s and pay stubs. If you're self-employed, you're not going to have W-2s or pay stubs. If you're retired, you're going to have 1099s and not W-2s. So once I have your application, I can provide you with a more, customized list for you. But that's, again, pretty typical list of stuff. And you see it up here as well. And this is the last slide. This is, and I kind of squished 3 pages onto one. So this is called the loan estimate disclosure. This used to be called the good faith estimate of closing costs. And one of the great things that the Dodd-Frank Act provided to us in 2010 was it made this document, this disclosure, binding. The good faith estimate before that was not. So you probably have heard the old bait and switch horror stories from lenders will provide a good faith and say, okay, here's your rate, here's how much you'll need for closing, here's your closing costs, here are the lender fees, and then you get to all the way to settlement, you go through the whole process of underwriting, and now you're looking at numbers are doubled or tripled from what they sent to you on the good. Can't do that. If I make a mistake, I forget a fee, we have to eat it. I can't come back to you later and go, oh, sorry, I forgot to put the property transfer taxes in. Nope, that's on us. So it's a lot of protection. It's a lot of peace of mind. It's not uncommon for people to talk to a couple of different lenders to compare rates and closing costs and fees. What is happening now in this competitive market we're in is some lenders are getting real tricky with this form. And this is the portion you want to look at. Closing cost details. It'll have the lender origination fee plus any discount points you might be paying, any other lender type fees will be in this section. And what I'm seeing now when people call me up and say, I have a loan estimate from ABC Mortgage and their fees are much lower than yours. And I'll say, send me the LE. Let me see what they're showing you. What lenders are doing out there is somehow they're deleting these fees from this section of the form. So when you look at this thing, you're not seeing their itemized fees on there. But technically, they're probably not violating any law because it's reflected in the annual percentage rate, or the APR. That, I have it highlighted because that's a very important number on this page. Typically, the APR is always higher than the actual note rate. So this is based on a note rate of 4 1/4, I believe. And yeah, so here's your interest rate right here, based on a loan amount of 405 at 4 1/4. And so that's a pretty typical APR for us. It's a little bit higher than the note rate. Why is that important? Because if that number is a lot higher than the note rate, that means there are fees baked in, and they may not be showing right there, but they're in here. So the lenders covered themselves by disclosing the APR to you. So if you see an APR that's much higher than the start note rate, you should ask some questions, and that should raise a red flag. I can't stand those games that the lenders play out there. It's not transparent. It doesn't help you. They're trying to trick you into applying with them. Obviously, we don't do that. We put every fee that we know about. It discloses as accurately as it can be at that stage of the process. We want you to know how much you're going to need. Surprises in our business are usually never good, and they're usually avoidable. So we go to great lengths to avoid those kinds of surprises. So, you know, this is something when the time comes we'll talk in more detail about once you have one in front of you and the numbers actually apply to you. But right off, if you see APR, that's the first thing you want to look at. That's on page 2 of the loan estimate disclosure. Compare that number to this number. It should be pretty close like this is. If it's a lot higher, then that's an expensive loan for you. I think that's my last, yep, that's the last one. So do we still have a few minutes for questions?
Sure.
Okay. Any questions?
I have one.
Yes.
I have two, maybe three. Closing versus down payment. What is the difference between the two?
Well, down payment is the difference between the purchase price and the amount of money you're borrowing to buy the property. So, you know, in this case, I think this was based on 10% down, if I remember correctly. Closing costs are mostly third-party fees. There's a lender fee. There's the appraisal, you know, so the appraiser has to get paid. There are recording fees to the county. There are transfer taxes to the county and to the state. Those are examples of closing costs. So that'll be in addition to down payment. And the amount you put for down payment will impact the interest rate. And I didn't want to drill too deeply into that today because it's just, you know, too much of a moving target. But when the time comes, I'll give you examples. Okay, if you put 5% down, here's your rate. If you put 10% down, here's your rate. If you put 0 down, here's your rate.
And my second question is about escrows.
Mm-hmm.
Escrow, I see the escrow fees up there added to your monthly payment. What does the escrow do?
Great question. Escrows are us collecting a certain amount every month along with your mortgage payment to put aside in an escrow account, a separate account to pay your property tax bill and your homeowner's insurance bills when those come due. So it's a lot like, think of it like you're opening up a bank account. You have to prepay to establish your escrow account. How much you have to prepay depends upon how much the taxes and insurance are for the property you're buying and when those bills are due next. So in Maryland, we pay taxes twice a year. It's a biannual thing. They're usually paid in June and then in December. So, for right now, if you purchased a home now and we're closing in a month from now, which is typically how long the process takes, the next tax bill is due in December. So we have to collect enough to have in the escrow account to pay that bill in December and then have a 2-month cushion as well on top of that. So, and some people ask about what's called waiving escrows, which is you don't have an escrow account. In some cases, that is an option. In most cases, it is not an option. In most cases, you do need, and frankly, you don't want to pay that bill. You get this giant tax bill twice a year. And by the way, they're going to send you the tax bill even though we pay it for you. And that's a common question I get after people are in the home. I got this bill, do I have to pay it? No, you don't. If it's escrowed, we've already taken care of it. It's just sort of FYI. Yes?
So I've heard, so you mentioned gifts and like receiving like a lump sum from family or whomever. I've heard that when you're actually in the process of buying a home, you shouldn't deposit into your account like right before. You need like a certain period of time. Do you recommend the 2
You're
months?
asking about seasoning of funds. Yes. No, it doesn't matter. With gift funds, it doesn't matter. In fact, seasoning has pretty much gone out the window for most things. However, it's another great question because it leads me to point out any sum of money that is deposited into your account that is not a payroll deposit. So payroll deposits will show on the bank statement as a payroll deposit, unless you still get a check, which I don't know anybody that does. But so it does say, payroll deposit from whomever. And any deposit really over like $500 has to be sourced and documented. So if you took money out of your mutual fund and deposited a $5,000 deposit into your savings account in preparation to buy the property, totally fine. But we need to see the statement from the account the money came from. And then we'll need to see a statement after the money's out of that account. And then we need to see a statement from the account that you put the money in. So there's a paper trail. If it came from here and it went to there. Yeah, so, but seasoning is not required for that, and there's no seasoning requirement for gift funds.
Not for like your tax refund, you just can't put them
No, don't need that either. And tax refunds also usually direct deposit unless you opt to get the check. If you do get the check, just photocopy the thing before you deposit it. That way you're creating the paper trail. And that's a good idea for any check type deposit or any transfer of funds from one account to another. So we can have that. And that's nothing new. That's been there for a long time, even before 9/11. And then after 9/11, it became more strictly enforced because they want to be able to track, funds. And they have a way of labeling what they call suspicious activity. So if there's a lot of money being moved around in a short period of time, they want to know. They want to know what that's about. Yeah.
All right, thank you, Bruce. We're going to hold questions to make sure that Maria has enough time for her presentation. If we still have time at the end, we can go ahead and ask more questions.
Okay, well, good afternoon, everybody. Pleasure being here with everybody. My name is Maria, and I'm one of the housing counselors with the Latino Economic Development Center. And what is the Latino Economic Development Center? Just because our main name is Latino doesn't mean we don't service anybody else in our demographic. We service everybody in the community. So our main focus of work is to provide community service to the community that could help advance the economic advancement of the community members. And how are we able to do that? By providing them and equipping them with skills and tools to achieve financial independence. And we're able to achieve that by providing a numerous of free services to the community. We have financial capability, first-time home buyer education, foreclosure prevention, rental counseling, tenant rights information, small business development, micro-lending, and we also have a new program under the Lending Circle program. That program can help you establish or build savings. Okay, so what are we going to talk about? My colleague here, well, he works for a different institution, but we work in the same field. So we're going to be talking about, are you ready to buy a home? What are the steps you can take? And he basically covered how what credit is, what different type of loan products are available for you to apply for. So what I'm going to cover is down payment assistance programs. Okay, what opportunities and options are available to you as Maryland residents? So there are several state, county programs that can help borrowers with down payment and closing costs. Most of these programs do have income limits. The limits may vary according to the program and where you're purchasing. Even though most of the programs do not require a specific credit score, you must still qualify for a mortgage. So it's very important to have your finances in place and your credit in place before you even take further steps into applying for any subsidy. So to be considered a first-time home buyer, most of these down payment programs are for first-time home buyers. And what does that mean, right? So it basically means that anywhere where you haven't owned or have any investment into a property or dwelling unit in the state or anywhere else. So if you've been a homeowner and you've sold a home, you cannot be eligible to apply for a down payment program unless you've been 3 years out off the deed. Okay, so the Maryland Mortgage Program. So there's statewide programs, as I mentioned, city and county. The Maryland, you can apply for a mortgage program or a loan with the programs that they have available. What do they have available? They have the down payment and closing cost in the form of interest-free deferred loan that can give you up to $5,000 in closing cost assistance. It's a 30-year fixed rate, and it's often lower than commercial lenders. So there's a little bit of benefits too in applying for the Maryland Mortgage Program because you can also apply for other benefits that they provide. This is just one of the main programs that they provide. There is household size limits, 1 to 2. You'll be eligible if your income is less than $130,020. For 3 or more, you'll be eligible to apply if your income is at $152,040. Okay.
Question. That's household income, correct?
Household
Not
income.
individual?
Right. Yeah. Household income. Okay. So the income limits may depend on where you buy. You still need to qualify. and you still have to use specific lenders under the approved Maryland Department of Housing and Community Development. So the first step is to get in touch with somebody in their approved list to be able to start steps toward applying towards these programs or to the Maryland Mortgage Program.
Is your bank member?
We're not.
Okay. Okay, so one of these products that they do have, if you apply for a mortgage program with them, is the Maryland Mortgage Grant Assist. What it provides you, 4% of the sales price. If you're using an FHA, grant can only go towards closing cost. If using a conventional loan, it can be used for down payment or closing cost. Cannot be combined with other Maryland mortgage programs. So if you're only using this program, you can't use the CDA, the $5,000. So because they're going to be giving you $4,000 in assistance. There's a credit score criteria of 660 for FHA and 680 for conventional, and there is maximum income limits, 130 for 1 to 2 people, 152 for 3 or more. So the benefits of this is that before it was for specific homes that you were looking into buy, it had to be in inventory under the DHCD pipeline, but now that's no longer. You can apply this specific product to buy anywhere in the state of Maryland. Okay, and it's grant funds. Okay. Okay, so to buy in Montgomery County, they have affiliations with the Montgomery County institution, and they also have a table outside if you have further questions to ask. So HOC is one of the organizations that administers the Montgomery County programs. The sales price cannot exceed $596,000. Can be used to purchase of condos, but condos must be approved first. And there's also income limits requirements. Okay, and that's if you're looking to buy in Montgomery County. Okay, so what are the options? There's 2 options. Well, there's 3 if you work for the county, for the county government. Okay, but we're going to mention only 2 right now. So the first option, you can apply for the Revolving Closing Cost Assistance, the recap, 5 for 5. So this provides you 5% of the sales price up to a total amount of $10,000. This will be a second mortgage that can be used for down payment and or closing costs. The loan is repaid monthly installments over 10 years with a 5% interest. So they will charge you interest on this amount. It can be combined with other FHA approved closing cost assistance, and at least one borrower must be working in Montgomery County. So that's very specific. Somebody must be working in Montgomery County in order to apply for this specific down payment program. And we have in your book, your folders, there's information of who you can reach out to, and I'll show it to you. So then, because we provide you a lot of information in your folders. So I want to make sure that you know who they are if you're interested in applying for this program. It's a 1-page. Somebody see it? I'm not able to find it here. Ah, here it is. The Housing Opportunities Commission. So that's the institution that administers these 2 programs. They also have their specific approved list of lenders. So if you're interested in applying for this down payment assistance, you have to go through their approved list. So I encourage you to look through the website, do some research, and this is definitely something that you're interested in applying for to start your steps to contacting somebody in their approved list. Okay, so the second program, option 2, and this provides a first mortgage plus 3% of the sales price of the property, which can be used for down payment and closing costs. The funds for the closing cost down payment assistance are provided as a deferred loan. Okay, so you don't have to make monthly payments. Okay, it's a 0% interest rate loan, and the borrowers do not need to be currently working or living in Montgomery County. You just simply have to buy in Montgomery County. Okay, so that's the other option. Okay, and the benefit is that it's a 0% loan and you don't make payments until you decide to sell or refinance the property or refinance the loan. Okay, so you can be living there, and if you're going to be living there for the rest of your years, you won't have to worry about this loan. Okay? So those are the programs to buy in Montgomery County.
Is there a maximum amount that it?
Yes, yes, we did mention it was, the maximum sales price cannot exceed $596.
No, the maximum
Income.
amount of the 3%, like
Yeah, it's the same.
the 3% of the home price.
Mhm.
Is there a maximum amount of it?
Oh, 10.
10,000.
10. Mm-hmm. 10, yeah. Oh, so, sorry.
I know the 5 for 5 is 10,000, but
Yeah. 10. Okay, so now we move on to the Prince George's County program. And they've actually come out with a new program also that we are going to discuss a little bit further. But the first program that they have is the Prince George's Pathway to Purchase. They provide up to $10,000 in down payment assistance, and it's depending on need. No minimum credit score is specified, but again, you must qualify for a mortgage loan. It's a 0% interest deferred loan. 10% of the loan will be forgiven every year. After 10 years, the loan will be forgivable, so it will be eliminated. The maximum purchase price is $307,000, and there's income limits. Okay, for one person household, the income limit is $61,150, and so on. Okay, so if you're looking to buy in PG, the first steps that we would counsel for you to take would be to apply for somebody under their approved list, because they also have an approved list of lenders. Okay. Any questions on this one? No? Okay, so we didn't have time to input the information for the second program that they have, but we do have the booklet of information here. It's the PG CPAP, CPAP program. Okay, and the booklet is in your folders. Prince George's County Purchase Assistance Program. Okay, the difference between these two is that the threshold of income is higher in this one. Okay, you can buy anywhere in PG. It's a deferred loan. They give you up to $15,000 in down payment assistance. It's 0%. It is forgivable, and if you're working for Montgomery County Public Schools, you can receive an additional $5,000. And it is also applies to any emergency personnel, first responders, that can also apply for this program and receive the additional $5,000, so that you'll be looking to receive a total of $20,000 in down payment assistance. PG County. Mm-hmm. Okay. So the next program, Tacoma Park Homestretch. They have a program in subsidy of $10,000. It's 0%. 20% of the loan is forgiven every year if it is your primary residence, and can be combined with the Maryland Mortgage Program. So your first step would be to apply for a Maryland mortgage loan, and then this can be combined. So you can be looking to receive a total of $18,500 in subsidy. There is income and household limits. So we have the chart here. For one person is $60,880. For two people, $69,520. Yes. Yes.
Can you combine the Tacoma Park Homestead and the Montgomery County?
No, you can't combine.
Only one.
Yeah, you can either apply for this one or HOC, the HOC,
and this is only if you live in Tacoma Park.
if you're looking to
And
buy.
you need to live in Tacoma Park?
Yeah,
Yeah, for this one, yes.
to buy a home in, no, it's to buy a
It's
home in
Tacoma Park. Mm-hmm.
No, I don't think we have any. I'm asking, you need to live in Tacoma Park, the
To-
city of Tacoma Park?
No, you just have to buy in Tacoma Park. Mhm. Okay. Another local program is the new neighborhood program, College Park. It's $5,000 towards down payment and closing costs. You must buy a house that has been rented for at least 2 years, or foreclosure or short sale. It is grant, and it doesn't have to be repaid. You must live in the house for 5 years. So that's one of the programs for College Park. And then there is the MPDU units. That's another program that is administered through HOC. If you're looking to buy a home that's moderately priced, a lot of the market values here are very high. So this is a program, and it's a lottery-based system. So one of the first steps that you will have to do is enroll into their workshops, attend different education classes, and then once a lottery is run, 10 people are chosen to be able to apply and buy that unit. Okay, but they're new units. They're also units that are being sold in the same process, so it can be anywhere in the county. So that's another option that you can look into. They have that program throughout Montgomery County, City of Rockville, City of Gettysburg have their specific program, City of Laurel, and City of Annapolis. They all have these MPDU units. You can have the opportunity to rent or buy. Okay?
In using the MPDU program?
Yeah. There's income limits. It will vary according to where you buy. The minimum will be around 35, and the maximum income will be between 70% AMI or 80% AMI. And every municipality has their own rules regarding the first-time home buyer class, so you must attend one of those requirements. And for most of these programs, one of their major eligibility criteria is that you attend an education class. And we provide those classes, but there's also numerous of nonprofit agencies that provide the classes throughout the county. Okay?
They're listed on the Maryland Mortgage Program website also.
Yes, yes. All the counseling agencies are listed on the Maryland site. Yeah, they're approved counseling agencies. Okay. Any other questions on this? Okay, and the information is there. I showed you the information of HLC, and they also have a table here today. Okay, so we just also want to give you information about your rights. Throughout this process, you'll be dealing with a lot of professionals, and if in that process you feel that any of those professionals has violated your rights based on color, national origin, religion, personal appearance, we want you to be aware of what to do and what actions you can take. There is information in your folders as to who to contact, where to report those individuals. Okay. So I know we don't have much more time.
Right, yep, time is up, so if you can give Bruce and Maria a round of applause for